now the second panel discussion of the day today, which is panel discussion on PMS and alternative investment. It is one of the most talked about topics recently, but it has not got the kind of platform that it should, probably. So I think what better than this event today, and we have the best minds of the industry to be, who are present here as a panelist in this panel. And the moderator of the panel is Mr. Deepak Jain. So evolving alternative investment PMS in India, a portfolio must have. Panelist, we have Mr. Anshul Saigal, CIO, Kotak Portfolio Management Services, Kotak AMC. Welcome, Anshul sir, to the event today. Mr. Dhaval Kapadia, Director, Portfolio Specialist, Morningstar Investment Advisors, India. Welcome, Mr. Dhaval, to our 10th Annual Wealth Management Convention. Mr. Rajnish Girdhar, CEO of Karma Capital. Welcome, Rajnish, sir. We have Mr. Mohamed Irfan, Fund Manager, Vivriti Asset Management. We have Mr. Apoorva, Vora, Founder and CEO, Finolutions LLP. Welcome, Mr. Apoorva. I welcome all the esteemed panelists for this panel discussion today and making our event successful.
So, good evening, everyone. We have a very nice panel to discuss a very important topic, a very upcoming topic in which I think many financial advisors and distributors lack somewhere in understanding this segment and knowing what is the importance of this segment for them, right? So, I'll be asking some basic questions before we move into the nitty-gritties of PMS and AI. And I would first start with the PMS part. So, and the basic question which I am asked by distributors across is, what is the difference between a mutual fund and a PMS? So, it is open to all people who are from the PMS industry to explain to us what's the basic difference between a PMS and a mutual fund.
Good afternoon. Pleasure to be here. Thanks. Yeah, so one is, of course, the structure of the product. A mutual fund is a pooled investment, while a PMS is a segregated investment. That is, if Deepak ji has a PMS account, he will have a separate DMAT account in which his shares will be bought. And so also other people in that fund, they will have separate accounts, segregated accounts, where their stocks will be bought. So to that extent, this is not a pooled investment opportunity. And that offers the option of customization. If, for instance, a mutual fund 5 years back had bought, say, Astral pipes at 100 rupees, and today the stock is 500 rupees, and it is there in the fund, then new investors coming into the fund will have some exposure to Astral by virtue of that being part of the fund. But the option of customization that is offered by PMS is that if there were investors who were in PMS 5 years back and who held Astral, it's not necessary that clients coming in today will also have to buy Astral, because for them, the portfolio may be different, and to that extent, there may be a level of customization which may be there for new clients. So this structural difference in the product offers customization opportunities. And then, of course, it is also the flexibility of the product in which there are differences. Mutual fund industry is very well regulated, very well defined by the regulator. And to that extent, there is very little room to move around that regulation or structuring in a sense. While in the PMS industry, you have you have concentration, you have the option to buy into stocks which are typically not present or don't find expression in mutual funds. And so you get access to a segment of the market which is quite different from what you get in the mutual fund industry. So to that extent, the structure and how investments are made, there is a difference between those. And as I always like to say, in a thali is like a staple diet. I mean, if you want to eat a staple diet, the thali is what you get. But a thali is not complete till you eat the dessert. And alternate products, PMSs, are the dessert. And that's really what you need to also have in your entire diet to have a complete meal, basically.
So another question is, what's the difference between AIF and PMS? If somebody can throw light on.
Yeah, so in PMS, like my co-panelist said, it's a segregated portfolio. There's a discretionary and a non-discretionary PMS wherein you get to either instruct or the portfolio manager uses his own discretion to manage the money. In AIFs, the key differentiation is that you come in with a fixed tenor and a fixed lock-in, and the investment manager sort of takes the investment calls and manages the fund just like how a typical equity or a mutual fund manager would be doing. But the only difference being that the money is sort of locked in. This is for category 2 AIFs. Minute you go to category 3 AIFs, you also have an option of providing liquidity, at which end it is akin to being like an open-ended scheme, mutual fund scheme. So in short, if you look at AIFs, you have to come into one of these 3 categories, which is category 1, which is your PEVC investments, and then you have your category 2, which is your mostly debt investments, and category 3, which are open-ended, long-short investment strategies can be run through the category 3 AIF structures. That's in short.
Great, sir. Another question is, and it's a hypothetical question. Question is, suppose I am an investor aged around 40 with around 5 crore rupees investable surplus or investable portfolio. Should I invest into PMS or AIF? What benefits would it bring to me? And how should I go about finding one which is best suited for me? And this I like all the panelists of ours to take it.
Okay, so let me try to address this. While this is an advisory question, I would normally not prefer an advisory answer, but still. See, first is that you have, we need to make one thing very clear. We should move to PMS or an AIF if there is a need for us to do that for an investor. Just because somebody is having 5 crores of ticket size does not necessarily mean that he needs a PMS or an AIF. That's my personal belief. That's point one. Second thing is, while I completely agree with what Anshul spoke about, that PMS from a vehicle point of view is different and there is a possibility of customization and all. But if you're going to use that customization, then there is definite need for you to look at a PMS. If after investing you want to treat your investment just like a mutual fund where you want to remain passive as an investor, then I don't see the need of getting into PMS, right? AIF, again, let's think about it. And when I'm talking about AIF, I'm not talking just of listed equity AIFs today. AIFs are of multiple categories. If we want to have an exposure, so again, let me come back. The parameters given to me, 5 crores, ticket size, 40 years of age. I have a reason to believe that somebody with that age might have ability to take little extra risk, might want to diversify beyond equities also, and therefore could look at credit funds, may also look at a venture capital fund and all. That is meaningful diversification. So we need to look at, and this is an advisor's job to figure out whether this investor with a 5 crore ticket size, does he require this kind of diversification or not? If there is a need for diversification, then there is merit for all 3 categories: mutual funds, PMSs, and AIFs, all. This is my personal view.
Yeah, hi. No, I think taking a cue from Apoorva, I think let's just step back a little, and if you look around the world, as wealth grows, the need for various different asset classes, products, and diversification arises. So, you go back anywhere, just to go anywhere in the Western world where wealth creation maybe started 100 years back in a systematic way, right? At that point in time, maybe they also only had a mutual fund, and then they slowly developed passives, then they developed alternate asset classes, venture funding, everything came through. I think it's the same journey which we are going through as a country in India. As the wealth effect starts to explode, as various different kind of investors come into the market. So maybe it's not just the wealth is lying with business houses or with entrepreneurs, it's lying with corporates, it's lying with individuals who made money out of their ESOPs options. So when you get wealth creation happening, then you also need avenues for investing money in a differentiated way. So maybe, and you need everything. You need a mutual fund, you need an ETF, you will need an AIF. But in the AIFs or in the PMS space, even if you look at it currently, I think equities would probably still be the largest holding, public listed equities would be the largest holding of most large clients. But even in the listed equities, if that is your largest holding, how are you going to diversify across styles? There is no point in having equity exposures to funds which have similar holdings, similar sectoral holdings, similar value or growth. So you kind of have to diversify in styles as well. And I think that's where the AIF and PMSs start to happen. So in a very simplistic way, as wealth explodes, as your client's wealth increases, so does his need, and so does this requirement for AIF and PMSs to come in. There was a thought process around why SEBI has probably brought this asset class out. So I think that's where the whole fundamental lies in my view.
Hello. Yeah. Hi. Good to be here. Everyone's been talking about perspective from an investor's point of view. Maybe I'll just change track a bit if you allow me, and also talk about it from a an advisor or a distributor kind of perspective, right? I mean, I think that's important as well, because in a way they are the ones that are connecting, with the end investor, connecting, the product manufacturer with, their clients and so on. What we are seeing, at least in some of the other markets, I mean, whether it's the US and, other global markets where, the investor segments are much large, the advisor segments are also very large. The way advisors are using, PMSs or managed portfolios, as they're referred to in many markets, is essentially, instead of trying to reinvent the wheel, each advisor trying to create a portfolio of their own, which they give to their clients, whether it's a stock portfolio or a mutual fund portfolio or whatever else, or a multi-asset portfolio. Instead of trying to do that on their own, they are sort of leveraging, what PMSs and AIS have to offer, which is obviously, it could be a portfolio of stocks, it could be a portfolio of mutual funds or ETFs as well. And, I think that's an area where probably, obviously, where as an advisor or a distributor, you would stand to, gain much more. You don't, as I said, you don't have to reinvent the wheel all the time. You could use the expertise that, others have created, or they're using to create, these portfolios as such. So I would think, in addition to investors, I think there is a lot in it for, an advisor or, a distributor as well.
So, remaining to the PMS only, what are some unique PMS offered in India, and how are they different? What are the different types of PMS options which clients have?
So, as such, the traditional PMSs would, again, like the mutual funds, would classify between a large cap and a mid cap and a multi cap and all. There is not, so there is a very, very much available. We also have some PMSs which would play thematics, sectorals as well. There are multi-asset class options available. So PMS is no longer just confined to the traditional now. In the last few years, we have seen emergence of newer themes, even within PMS. So yes, there is to that extent a little differentiation which has come in the recent times. But this is when we confine to PMS. And since the question is confined to PMS, I'll leave it there only. In AIF, you have a lot more other options available, of course.
Would you like to add?
I'll just supplement that point. I think that there is a lot of flexibility available to do permutations, combinations within PMSs. For instance, we at Kotak AMC have a product where we have two sectors which are part of the PMS. One is finance, the other is technology. We call the product fintech. Now, finance being a cyclical sector is kind of complemented by technology being more secular in nature. And to that extent, this offers a different product to the clientele. This is not a product that is available on any other platform, particularly the mutual fund platform. I don't see any product of the like available to clients. Similarly, you have the ability to combine different sectors, different themes, and make products out of those. For instance, you could have a product out of geopolitics, for instance, what's happening just now around the world. Things like that, and those are options that are available on the PMS. And the other thing is that in the PMS makeup or regulatory framework, you could act fast. That's not an option in other products, neither in AIF nor in the mutual fund scheme of things. So that's what. I mean, if you can identify an opportunity, last year was a great time to be looking at, for instance, PSU banks, government companies in general. If you had a product on those lines, that would have been a hit product this year. So these things, speed to market and various themes, that's what you could do in the PMS.
Okay, great. Now, what are the different types of AIFs available? Irfan would like.
Sorry, yeah. Right, so like I mentioned before, so in AIFs, you have three categories, but that's more a regulatory kind of a classification. But key differentiation, if you want to just have a view on, is that in category 2 AIFs, it's fixed income and there is no leverage that's allowed. And in category 3 AIFs, there is leverage that is allowed in that category. So most of the time you would see that equity strategies, long short strategies, like I mentioned earlier, these would be using the category 3 license, whereas most of the fixed income strategies would be using the category 2 license. But a little bit delving deeper into the asset class in itself, and I would speak a little bit more with category 2 AIFs because I am from a credit in fixed income investing background, and that's the firm Vivriti also does the same. So what we like to see is that there is a white space right where wholesale NBFCs and mutual funds used to play, which is at the plus 8.5% kind of a yield, all the way up to 15 or 16%. Now this space is not being adequately served today, and a lot of category 2 AIFs have developed debt strategies to attack this space. So the earlier strategies in this space were either looking at real estate investing or venture debt investing, special situation, or distressed. Now these are all 18 to 21% category return, investment opportunities. But the whole the lot of the growth over the last 2.5 years, if you see, has been in this white space, and we like to call this as performing credits. And in our view, or at least if you kind of look at the numbers, this seems to be in category 2 the fastest growing asset class, and where investors are allocating the most amount of capital, because risk adjusted returns make a lot of sense in this space, because you're doing the same simple boring debt, and you're not moving on to you kind of stepping back from the really esoteric stuff done at 18 to 20%, which requires a different sort of investor mindset. So broadly, that's at least on the fixed income side. I would like, if anybody else would like on the equity side, category 3 ones would be great to add.
I would like to, yeah, sorry. I'll probably like to just go back to PMS for a minute in terms of, differentiated kind of products or offerings out there. A space that we've seen in a way in India is probably still nascent but growing is, multi-asset strategies as well. And this is fairly big in other markets, such as the US, Australia, UK, and other places where, the managed portfolios of PMSs out there, a bulk of them offer multi-asset strategies, investing across, different asset classes, including, Indian equity, international equity, fixed income, REITs, and so on and so forth. So that's another area where, PMSs in a way provide an end-to-end kind of a solution. When we talk of, individual asset classes, a lot of them, obviously form a part of a client's portfolio, right? I mean, you could have an X percentage to an equity PMS or an AIF and so on and so forth. But, a multi-asset strategy in a way can form, a larger portion of a client's portfolio. And that's how clients will, tend to invest as well, into different asset classes to meet, various goals as such. So, I think that's an area as well on the PMS side, which probably is growing, at this point of time.
Great. One more question we have. We have many distributors sitting here who have non-resident Indian as their clients. So what opportunities does PMS and AIF space throw open to those people, and what are the tax implications of suppose a non-resident Indian investing in India through PMS or AIF?
I think the opportunity for NRIs maybe increases a little more in terms of when you come through a gift city kind of a route. But in general, in the AIF and PMS, all NRI clients can invest. Now, PMS being segregated and having a brokerage account, you obviously have a little bit more, you need the regulatory environment for getting a PINS approval, which is pretty simple. But once that is done, I think the opportunity, what I believe is a bigger set now is for NRI investors who would normally go to offshore jurisdictions like Mauritius, like Luxembourg, can now come into a gift city kind of an environment. I think, as I said, it's an evolution of the Indian regulatory environment. The government first came in with an AIF PMS, with a PMS which was there, then it came with AIFs. And now with Gift City, you can get a client who's sitting in anywhere in the world. As Indian asset managers, it gets much easier to set up an asset management business in the Gift City and get that money in. I'm not a tax expert, so I'm not going to talk too much about the taxation part. If there's anybody else who wants to take up about the taxation. But my sense is, as most of our panelists are referring, access to multi-asset classes using the AIF PMS structures, getting offshore money in an offshore format, in the Gift City format. I think these 2-3 things are the most exciting things that I see from an NRI perspective.
So I completely agree. I'll use your sentence. I'm also not a tax expert. But one small advantage, and I'm just giving a very small advantage of Gift City, is that you don't pay STT, you don't pay, so right from GST to STT, there are all those tax advantages which a Gift City authority would give to an occupant there. Now that would also help in terms of reducing the cost burden to the investor marginally, which is an added advantage when we talk about a competitive landscape of fund management.
So, how many of you understand the Gift City structure? How many of you do that? So, sir, that you'll have to explain.
Okay, my apologies for that. So Gift City is kind of an offshore jurisdiction within India. There is a lot of global countries which have adopted this. For example, if you go to Dubai, there is something called as a Dubai International Finance Center, where the local regulations don't apply. And there is a separate set of regulations which applies, which is essentially to attract offshore money coming into the country so that they don't get entangled with maybe the local regulatory guidelines, local taxation guidelines, and even times within the local banking guidelines of being able to get money in and get out easily. So under the IFSC, which is the International Finance Center regulation, in Gandhinagar, they've created a whole 300-acre environment for creating an offshore center into India, which will cater to both money moving out of India and money coming into India, which will have large implications in terms of financial services, but they're trying to look at other capabilities as well. So you have banks. So for example, if an Indian bank had set up a branch in Singapore and had certain advantages of doing business, they can do the same thing by doing a branch in a gift city. So they can lend offshore, they can do transaction in dollars, etc., without having to bother about local regulations. And the same thing happens for an asset management company as well. I don't know if I can simplify that any further or if you can do that for me.
So I'll take it up because I operate out of Gift City, right? So in very simple terms, this is a global jurisdiction. I need to have my bank account in dollar terms. I can't do a rupee transaction in Gift City. A single rupee receipt is not allowed in Gift City if I'm operating from Gift City, right? So that's one big difference, which obviously means that, and essentially in that 850-acre area, the moment you enter in, you have to pass the customs, then you enter into the area, right? It's been quite some time that I've been operating there. Because I want to bring in my used television set for my conference room, I'm not getting the clearance because I don't have an invoice. It is that regulated. I'm giving this example just for someone to get an idea. What kind of regulations are? So it is an actual import of goods that I need to do if I want to bring in anything within the gift city. So it's a complete global jurisdiction. And like what we just discussed, there are huge advantages if somebody is looking at particularly the non-resident Indians and foreign investors to be managed in India. So far, we have actually not gone beyond NRIs when we talk about managing overseas money. But if you look at, there are a lot of institutions who are now looking at India as a destination for them to invest in. If that is what we are looking at, and even as fund managers, if somebody is looking at getting into that segment, you practically have no choice but to go into Gift City and operate, right? So that's, you can think about it at that 850 odd acres that we are talking about is a global jurisdiction within the democracy of India.
So if I can simplify this further, how many of you heard the Mauritius route? FIAs invest through Mauritius. So we have created a Mauritius in India, basically. So my last question to sum up, and it is open to all panelists. What do you see the growth areas in AIF and PMS space going forward, maybe next 20 years in India? Where will the growth come and what are the opportunities for distributors to be part of this growth?
In the listed markets, the PMS and AIF industry is now, it has gained scale. The industry is about 2 lakh crore plus. And that, I think, compares to the mutual fund industry being at about 17,000 crores in equities. So this segment of the market has gained scale. And it is by virtue of size and base, this industry is growing at a faster pace. Also, if you go into the psychology of the investor, typically in AIFs, you have investors who invest at the least 1 crore rupees and higher, and in PMS is 50 lakhs, so typically falling under the HNI category. Now, these are investors who like to feel different in how they do things, right? Whether they're wearing a belt or a jacket or shoes, they like to buy things which are different from what the regular masses buy. And to that extent, buying off-the-shelf products versus buying bespoke products, they would typically gravitate towards bespoke products. And that is what this industry offers. I see that there is going to be a gravitation of HNI segment of the market, particularly towards this category of products. And we have seen that over the last few years, maybe 5, 6 years, that this has happened. This trend is playing out. And it's only going to catch pace going forward. So I see that this industry is going to gain further scale, further weight, and it's going to become a relevant segment of the market going forward.
I would obviously echo what Anshul has said. I think there is a lot of headroom for the industry to grow. It's still, although it's got to a sizable, a reasonable scale, but there is definitely a lot of headroom. In terms of, as of today, most of the industry is concentrated, at least the PMS industry is largely concentrated on, direct stock strategies, right? I think probably that's something that would also change going ahead, is the way I think of it. And I spoke of it a little bit earlier, like, multi-asset and other kind of solutions will also probably, gain larger prominence, within this segment, and which will obviously work well both for, investors, who want an end-to-end kind of portfolio solution, as well as, advisors who want to leverage, the expertise of an investment manager as such. So I would think, that's one area in which, the industry probably would also sort of, grow further as such.
So right now, how is it geographically concentrated? Is it limited to metros or tier 1 cities, or are we going to tier 2, tier 3 cities also?
So our experience has been that it is already there in tier 2 and tier 3 cities, right? And even I'm talking about AIFs as well. They are very well spread. They are not confined to only these metro cities that we know of. Continuing to the same thing about the growth of PMS and AIF. Yes, there is no doubt that PMS as an industry has grown, and the very, very interesting thing is, it has passed the test of times, as we say. When the ticket sizes increased to 25 and 25 became 50 lakhs, these were all stages where there were apprehensions whether this industry will do well or not. And actually the numbers say that after that, the inflows have been even more. Aggregate inflows have been much more. So this was a mental bottleneck that we had, that PMS has to be at 10 lakhs or at 25 lakhs. If tomorrow this was to become a 1 crore ticket size, I am now very confident that it won't have any problem for the industry. So industry is out of gravity from that perspective. That's my first take. On AIF front, again, if you look at, and if you go through the numbers, in much shorter span of time, in almost, PMS has been around since 99, 2000. But if I talk about AIF, it started in 2012, later half of 2012. Much shorter time frame. It's almost more than 2.5 times of the PMS industry by now. We should also look at little more insight into this data, and we will get a lot more information about this. First interesting thing is that nearly 50% of the AIF, because we don't have AIF AUM data breakup by breakup, and that records are not available anywhere. The only way for me to judge is the number of AIFs which are there and what's the quantum of money which goes into various sub-asset classes. If I go with this, nearly 50% of the AIFs are in the private equity, venture capital, and angel investing space. Actually, only on the registered AIF, if I look at, listed equity constitutes only 10% of the total AIFs. It's an interesting pie chart for someone to just follow. So the point is that this significant amount of growth has happened because it offered a meaningful diversification beyond equities also for a lot of investors. And this is why private bankers have chosen those kind of routes much more for them to allocate money. But the industry growth is going to be phenomenon for both. There is no doubt whatsoever. 20 years, too difficult to say, because by that time there will be so many regulations. And today, with all due respect, there are some regulatory arbitrage which are working to the advantage of AIFs. If they are tightened, how many people would then be interested in AIF? These are all questions which we don't know today, because this is very fluid. But so far, the data has been excellent. And as of now, foreseeably long period, PMS and AIF will coexist and grow in the same space exceedingly well. I don't have any doubt whatsoever.
Yeah, I'd again like to bring in color with just the debt asset class, because there it's almost a no-brainer, because if you look at the risks that fixed income managers look at, there's duration, there's credit, and there's liquidity. And if you see where MFs have lost out, it's largely been not because they've taken very bad credit calls, but because they've operated in a vehicle where liquidity is required. And once you kind of compare, most of the time, because we are attuned to equity investing, we seem to discount liquidity because all the returns that you've made, right, over the last, your equity investing journey, if we exclude dividend yield, it has just been because there's liquidity in the market, right? Someone else, bazaar hai basically, simple, right? Fixed income mein bazaar nahi hai. So jab bazaar nahi hai and then you are working with NAVs which require the liability to be a one-day liability technically, it becomes a non-starter to actually do any kind of credit, and which is why after the credit risk fund category reduced from 1,30,000 crore to about 35 odd thousand crore today, you have seen that all the incremental growth is coming in the AIF space, because here you're solving for liquidity, right? And most investors who want to come in will want the liquidity bit solved, and then they want stability. And they would go with asset managers who offer stability in returns and who've had a long gestation there. And given that fixed income is somewhere where most people do not want to spend too much of their mind space, they just want safe returns and stable returns. So that is something which, without volatility, without MTM, AIFs are able to provide on the fixed income side. And that's why it's been growing over the last few years. And over the next 15, 20 years at least, till you see bond market liquidity come in the AA, below AA space, which is at least 2 decades away. Today, I won't even say liquidity is present in the AAA space across the board. So it would take at least 20 years for this liquidity to come, which is the kind of the tailwind for the AIF industry on the fixed income side to grow. And we've already seen that happen over the last couple of years.
I think everybody's talked about the asset class diversification, and Irfan's just talked about fixed income diversification. And maybe public equity market still contributes only 10-15% of the AIF, but I think it provides a very important opportunity in the public listed space because it allows you to differentiate. It allows a fund manager to express his or her style of investing because they are not really bound. The kind of investors which can come in, which are patient, which allows you to express how you want to manage money. And for an advisor, it allows you to blend the style in a way which is not constrained by the bigger regulatory environment for mutual funds. So what do I mean by this? So you can have a value side of investing, you can have a growth at reasonable price investing style, but it's very difficult in a mutual fund environment at times because of the daily NAV pressures that the mutual fund portfolio managers face at times, for people to take a bet that I am investing in a stock for a 2-3 year period. I believe there is a lot of value in this stock. And that allows for diversification of portfolios of larger clients in a lot easier way, because you can see what the portfolio managers are doing and a discussionary and the discussion can happen. For example, we do something what we call as early cycle in a public markets environment, where we are looking for a company which probably may not have done very well over the last 2-3 years, but has strong growth characteristics coming through with some catalyst now. But to take that kind of call, I need a 3-year kind of a horizon to, kind of get my investors in. So simply saying, even in a public markets environment, a lot of style diversification can be brought about by the AIF and PMSs. I think that I'll leave it up at that.
So with this, we conclude the panel and we are open to questions. If any one of you have questions, we can take up to 2-3 questions, not more than that. Can you please pass the mic? Category 1 AIF.
Yeah, so category 1 are PVCs and social infrastructure company investments. So they are generally not managed by asset managers such as ourselves. So most asset managers would be operating in the category 2 and the category 3 space, which is either your fixed income or fixed income / equity strategies on the category 3 side.
Yes, your questions. Yeah, please.
Yeah, my question is on active versus passive. I want to know from Morningstar, Dhaval Kapadia ji, how much percentage of funds in 1 year, 3 year, 5 year, 10 year category have beaten the benchmark in percentage term?
I think
all put together, PMS, AIF, as well as mutual fund.
so. You're comparing. You're asking
Active
for
versus passive.
Okay, you're saying overall how many PMSs have done better than
Benchmark.
the benchmarks?
In
Okay.
percentage term.
Okay. So,
Even in mutual fund also.
okay. So I would say it would, differ from, buckets in the sense that large cap funds, obviously we've seen over the last few years, underperforming, many of them or several of them underperforming their benchmarks. Of course, the market cycles and so on and so forth play a role in the performance. But if you look at, for instance, the mid and small cap categories, I think by a large number over the last 5 to 10 years, a good share would have outperformed, their benchmarks as such. And again, I would say that is applicable even for, PMSs. In fact, most of the PMSs would tend to be either, small and mid cap focus or multi-cap kind of focus PMSs. At least the small and mid cap ones, at least as far my understanding goes, they've outperformed the benchmarks. I think there's some challenge on the large cap side where we are seeing, the alpha sort of reduce. Not to say that there are no funds doing well, but there are funds that are outperforming, but maybe, the percentage in terms of the, the percentage of funds outperforming, probably, that has been sort of coming off, a bit, yeah.
Any other question? One.
Hello, my question is that why it is the PMS having a minimum ticket size of rupees 50 lakhs? What about the small investors if they want to invest?
I take that question. The reason is that there is an inherent assumption that if you have more money to allocate, then most probably you are someone who is more aware of managing money or have an appetite to take a little bit more risks. I'm not saying these two assumptions are 100% valid. They are not. But from a regulatory perspective, the job is investor protection. So with that lens, they are not kind of categorizing, the haves and the have-nots in the investing world. That's not the job. The job is to make sure that someone sitting in a small tier 4 city is not being missold a product at any cost. And that's the regulatory lens and we have to respect that. So that is 50 lakhs for this. For AIFs, it is 1 crore. So the idea is to, as you increase the barrier, then these assumptions would more likely than not hold the system in kind of good stead. That's the assumption that these numbers are with.
If you look around, the government, SEBI has also come out with a definition of an accredited investor or a sophisticated investor, which is the norm worldwide. Basically, that essentially means that you understand the markets fairly well, or you're a fairly high net worth individual for whom if they make us an investment of 50 lakhs, it's not a very large chunk of your portfolio, so that the risk you are exposed to is not high. Or you've been in the market, you understand the risk, so you can take that kind of a risk. At the end of the day, regulator is very, very clear about protecting retail investors. In India, if you believe if you're above 50 lakhs, then you're not normally a retail investor if you're putting money in a single fund at 50 lakhs and above.
With this, we end this panel.
Thank you so much, panelists, for the wonderful discussion on the very, very needed topic of PMS and AIF. Thank you to all the panelists. And thank you for gracing our event. Thank you so much. Thank you for the wonderful photograph. So this made our evening. Thank you so much to all the panelists. Thank you so much.